So this is significant influence. And so what we're talking about is we're talking about more than 20% of the company, but less than. All right, you doing good?
Yes.
All right.
Cheat troubles, we got it figured out.
All right, less than 50%. So that's significant influence, right? And so it's the equity method. So what this means is you record it at cost, and then what it is you record at cost. So in this case, what they did is on January 1st, you have long-term investments. You paid $7,650, and then you credit cash, $70,650. Okay? So this is when you bought the company, when you did an investment. And you bought more than 20, but less than 50% of it. Okay, in this case, what you did is you bought 30%. Now, what you do is you adjust this for the equity. So in this case, what it is, in this example, the subsidiary had, so you bought 30% of the company, they had a $20,000 net income, and they paid out $10,000 in dividends. So, 20,000 times 30%, that comes to 6,000. And then you have 10,000 times 30%, that equals 3,000. So this is the portion of the net income, this is the portion of the dividend. So here's what it looks like when you buy it. Now, at the end of the year, when they report a $20,000 net income, you own 30% of the company, so $6,000 technically that is yours, right? So what you do with that is, this is December 31st, what you're doing is you have long-term investments, that increases by 6,000, and you have earnings from long-term investments is credited. Okay, 6,000. This earning from long-term investments, that's a revenue account, and of course, because it's revenue, it goes to the income statement. Sound good? So what it is the net income for the company was 20,000, you own 30% of it, so 6,000 that is yours. So that increases the value of your asset, and it shows up as revenue. Okay? Now, they had 10,000 in dividends, 30% of that came to you, that's 3,000. So what that means is, all right, and this is December 31st. Let's say that happened on January 9th. What you do is you debit cash for the 3,000, right? And you credit long-term investments for the 3,000. For the 3,000. Does that make sense? So, basically what happens is your investment tracks the value of the subsidiary. So when they have a net income, your investment increases by your portion of the net income, right? When they issue dividends, you receive that cash, but the value of the investment goes down because their business lost that much value. So you declare your share of the net income as an increase in your investment and revenue, goes to the income statement. You declare your share of the revenues as a debit to cash and a credit to the asset. In other words, your asset tracks the value of the subsidiary. Okay? All right. Now, let's go to the next category. So the next category, this was 20 to 50%, right? So the next category, you own more than 50%. That's called a controlling influence. So here we have significant influence. And often with significant influence, often what people do here is they buy a supplier or they buy this stock in a supplier or an outlet. And that way they're assured, it's like vertical integration, they're assured of getting whatever goods they have and they're assured of having a place to sell it. Is often what they do here. Okay? If it's controlling influence, that's 50%, 51% or more. And what you do is you consolidate the financial statements. Okay, so you consolidate the financial statements. And so what that means is you have one income statement that represents all the companies. In this case, let's just say there's two. You have one balance sheet that consolidates, so you report all the income as though it were one income, you read all the assets as though they were owned by one company. You consolidate all the financial statements. Okay? All right. Now, let's just touch on comprehensive income. So comprehensive income. So remember we had the unrealized gains and losses, and remember we reported those as an increase or decrease to equity if they're available for sale. They won't show up in the income statement, right? But they do but they are considered part of comprehensive income. So you have unrealized gains and losses from available for sale. Okay, so they do change the value of the equity, right? And they're also reported as part of comprehensive income, and we'll get more into this later. But that's what they're included as part of comprehensive income, even though they don't show up in the income statement. Okay? All right. So, everybody doing good? All right, let's get into this. Let's get into foreign currency. So, I'm going to turn out these lights because I'll use the voice. So, let's just kind of let me turn out these lights. Okay, I'll turn the camera around. Let's get into foreign currency exchange. Before we do that, let's just kind of sum up real briefly. So what we've done here, again, trading securities are actively traded. They're less than 20% of the company. They tell you they're trading securities. They're reported at fair market value. Unrealized gains and losses go to the income statement. Held to maturity means you buy them, you're going to hold them to maturity. And of course you report them at how much they're worth at that time. Available for sale. Now again, these are less than 20%. If they are available for sale, they're reported at fair value, but now unrealized gains and losses are reported as a change in equity. Non-significant influence means that you own 20 to 50%, and you use the equity method, so you report them at cost, and then you report your share of the net of the income for the subsidiary as an increase in your increase in your investment, right? And then if you own 51% or more, it's the controlling influence, and you consolidate the financial statements and report them as though they were one company. That make sense? Mm-hmm. Now let's get into the next section, and the next section is the exchange, doing business overseas. Okay, so the exchange rate. A couple summers ago, I spent some time in Mongolia. And I was going to an area that had a lot of pickpockets. So I divvied up all my money in my various pockets. And all these travel folks got lots of pockets. I got back and I found that I had 11,820 turi, the Mongolian currency. You can't exchange it outside the system. I thought, oh no, 11,820, darn it anyway. So out of curiosity, I went ahead and checked. Now, what's the value of 11,820? I'll show you here. So this makes the translation. So what it will do, in this case, I'm going to clear it. So this is Mongolian turi, and it will, see where the arrows, it'll turn into US dollars. So when I found that I had, in one of my pockets, I had 11,820 Mongolian turi. When I discovered that it was worth $6.96, I felt relieved. I didn't know that. Okay? And so, just out of curiosity, let me pass this around. Here's 10,000 Mongolian turi. Let me just pass it around. And by the way, I want this back. I'd love to get back to Mongolia someday. So if I have it, I'll do it. So, Randy, you can pass that around. There's 10,000 Mongolian turi. Okay? So that bill that's coming around, let me hit clear. It's worth $5.89. Okay? Now let's get into some of the exchange issues on this thing. So, all right, now, so here we have, so what we'll have here now is actually, I think I'm going to, this works so much better if I can go back and forth. There's some spots over here. I'm going to turn this back here and see if I can work with the spots in the blackboard and still make it workable. All right, so in this particular example, what we have here is, in this case, the U.S. Now, if you're going to buy and sell things in U.S. dollars, none of this applies because it works just like you've been doing it, right? But in this particular example, what we have here is what they did is they sold 10,000, something worth 10,000, and this is the, we'll make the British pounds. Okay, I'm just going to write pounds. So what it is they made the sale, they're going to be paid in British pounds. Okay? So when we do that, and at the time of the sale, a pound equaled $1.80. So $1.80 times this comes to $18,000. So at the time of the sale on December 12th, you debited accounts receivable for $18,000 and you credited sales for $18,000. Okay? It's because you're going to pay 10,000 pounds. At that time, a pound's worth $1.80. So that means you're debiting your accounts receivable for $18,000, crediting sales for $18,000, right? Now the end of the year comes, and the pound has changed from $1.80 to $1.84. So now $1.84 times 10,000 comes to 18,400. So your accounts receivable went from 18,000 to 18,400. So when that happened, this is December 31st. It's an adjusting entry. You have your accounts receivable will now be debited for 400, and you have a foreign exchange gain of 400. This is an adjusting entry. This foreign exchange gain, it's a revenue account, goes to the income statement, it's close to income summary. Okay? Now, then on February 10th, the money's due. Okay, the money's due. Now on February 10th, it's worth $1.78. So 10,000 pounds, $1.78, That comes to 17,800. So now, what you got here is the cash you receive will be debited for 17,800. Okay? Your accounts receivable will be credited for 18,400. That means you'll have a loss of $600. That would be a foreign exchange loss. So, to back up, if you're buying and selling in US dollars, what you've been doing up to this point applies, right? If you are going to receive or pay money in a foreign currency, then you have to express in the currency. So when you make the sale, you debit accounts receivable and credit sales for the British pounds expressed in US dollars. Okay? Then at the end of the year, you do an adjusting entry. Yeah.
Sorry, is that 1280 at the very bottom for accounts receivable?
12,800.
Why?
You
400. 12,400.
Let's see, let's take a look here. I'm sorry, it's right here, 17,800. Okay.
That should be 18. No, that should be 18,400. That should be 18,400.
Oh, you're right. It is 18,400. So it's 18,000, and where I'm getting that, Gene, is the fact that it's the value of the accounts receivable.
I know where I get it now.
What's that?
I just did it before.
Okay, all right, doing good. All right. So what you do now is you record the accounts receivable at its value at the time of the sale. You make an adjustment at the end of the year, either a gain or a loss. And then when you actually, in this case, you receive the money, you debit cash for the money you receive, you credit accounts receivable for the accounts receivable paid off, and as a plug figure, you'll have a gain or a loss. And of course, the foreign exchange gains or losses go to the income statement. Okay? All right. And by the way, this is what a British pound looks like. I have 10 British, this is the 10 British pounds, they call it 10 bob. And when I did it, it was a British pound was worth $1.60. That would have made this worth $16. Now,
It used to be $2 too.
yeah, and amazing,
I
isn't
have
it?
a question about that.
Could you guys make sure I get this money back?
Why